So again, welcome everyone. This is the option trading masterclass session 3, brought to you by Delta Exchange. Big thanks for Delta to make this happen, for making this happen, and big thanks to Anand Raj here with us from Delta, sharing his knowledge, help us navigate the options world. If you haven't watched already, I would advise to start from the previous sessions, which are in a playlist under my YouTube. I'll share the link below. And I think we can start right now. And let's have a quick recap what we've covered so far in the session 1 and session 2, and what we're going to cover in session 3. Yeah, Anand,
Hi guys, welcome back again. So let me open my presentation, and as Konkur was saying, I'll give a recap so that we are on the same page. And if not, definitely, as Konkur has already uploaded the stream over YouTube, so you can definitely go and watch it out. And if any doubts again in the next session, whenever it will be, you guys can again join and ask the queries over there. Just give me a second, and I'll be cool. Good to begin. Sharing my screen. Is my screen visible, guys?
Yeah, we can see your screen now.
Cool. So, a quick recap. Delta Exchange home of crypto options. Disclaimer. Okay, advantage of crypto market was it's a highly available market. 365 days it's open, and since it's a global markets, there is a good amount of liquidity. And since it's a high volatile, the potential of making higher gains are very much over here. This is ATR, which is an indicator which measures the volatility in the market. So I have compared some indexes of US market as well as Indian market. So clearly we can see that BTC and Ethereum are the indexes, or are the underlying which are highly volatiles. These are the options trading benefits. One is the hedging, the second is the cost of reducing the cost of holding the underlying, then the dynamic leverage and options data, and then the again the highest potential because of less premiums when deployed in the options trading. Options, we had two type of options. The one is call option and the put option. We buy the call option when we expect the underlying to go up. We buy the put option when we expect the underlying to go down. For buying the options, we pay a premium. Premium, you have two components. One is the intrinsic value and the time value. To calculate the intrinsic value, you just need to minus subtract the spot price from the strike price. And after doing this, whatever portion in the premium is left will be your time value. Moneyness of the options contract, there are three: in the money, at the money, out of the money. As the name says, in the money means that your market price is above the strike price. That means you are minting the money. At the money is ATM. That means your strike price and your spot price are same. And as the market moves in the direction, you will start making the money. Out of the money scenario is where you have no intrinsic value and you have chosen a strike which is far away from the market price. A simple example to demonstrate: 7,000 the current market price. Let's say for the call option, this is at the money. Also for the put option, this will be at the money. But in case of call option, if you let's say speak of strike of 6,600, this is called in the money because your chosen strike is below your market price. So this is in the money. Let's say 7,400 is out of the money because the market has still not came to 7,400. So it's so simple, easy. If you guys want this slide, definitely you can ask Conqueror, and this must be given to you. So in case you want to practice it again, you are definitely good to practice it. The opposite is the case of puts. This is the current market price, so this is at the money strike. In the money is 7,400 because the market is below 7,400, because we buy the put when we are expecting the market to go down. So market is definitely below 7,400. So 7,400 is the in the money case scenario, and 6,600 is out of the money because the market has still not come to 6,600. It is trading at 7,000. Hence, it is out of the money, or OTM. These were the Greeks: delta, gamma, theta, vega, rho. Delta is direction. So when your direction is right, delta will reward you for your for your right direction. Gamma is a Greek which will accelerate or decelerate delta. Theta is time decay. So every day as the time passes by, there is some decay, there is some erosion in the premium because of theta. Vega is volatility. So whenever the premiums increases, whenever the volatility increases, the vega increases, and hence the premium increases. And when the volatility decreases, the vega decreases, and hence the options premium decreases. Today we have FOMC minus, so definitely the vega is kind of increasing, and hence we can see the options premium also slightly getting inflated. The next Greek is rho, which is change in options premium based on the interest rate. This doesn't impact a lot on us, and is not a often day scenario. Moving further, so delta again, for at the money the delta is 0.5. Hence we generally, when we buy the options, we try to buy at the money call so that we are 0.5. When I say 0.5, it also means that you will be rewarded for right direction in the 50% portion. Means, for if you have guessed your direction right, then 50% will be rewarded. On the other side as well, if the direction is wrong, you will be not penalized 100% for it, you will be only penalized 50% for it. So as soon your direction is right, this delta 0.5 will start increasing to 0.6, 0.7, 0.8, and the maximum is 1. So in the money case, the delta is 1, and this is the case where your options premium will increase as the underlying increases. So they are like 1-to-1 ratios. Okay. So for buying the options, it is always supposed to, you should be looking to buy options where you are at the money, and hence you are at 0.5 delta. Calls have positive delta and the puts have negative delta. The maximum delta for calls can reach up to 1, and for puts the maximum delta on the negative side can reach up to -1. As mentioned, that this delta of 0.5 goes to maximum 1. Why it goes to 1? It goes because of the gamma. Gamma will accelerate and decelerate delta. The next is theta. Theta generally is the time decay. So when you buy the options, just try to buy the options with a longer expiry, or yeah, when you have sufficient number of days. And when you sell the options, look for shorter term expiry, because I mentioned that as the number of days for expiries are less, the theta, or the time decay, or the time component in the options premium, the erosion is fast. So when you sell the options, look for shorter expiries or short term contracts, less than a month contract. Okay. Vega, which is volatility, again, as the premium increase, the vega increases, the volatility increases in the market. So this was a small graph that at the money 0.5, and as your underlying moves, your delta increases to 1, and this is where your premiums will increase. And at this point, your options premium and your underlying will move in a parallel fashion, and it can maximum go to 0 delta. That's it. So maximum loss in an options buying can be 0. You cannot lose anything beyond what you have already given. We'll take the practical example of this. This is the time decay theta value. The You can see the slope of this graph increases as the number of days are coming closer, and hence when you buy the options, try to be have more number of days in your hand, and when you are selling the options, try to have less number of days or less expiry in hand. Implied volatility, this is the graph, just to keep our image in your mind always. This is behaves like a pendulum, so you can see the pendulums is always unstable at the extreme positions. So pendulum always tries to come back to its mean position. Similar with the options premium, when there is implied volatility, high IVs in the market, the options premiums get inflated, and these inflated premiums are not stable. They have to return to the mean or the fair valuations very soon. That is why you see when the event is over, in just 30 minutes or let's say 1 hour, the entire inflations or the air that is inside those premiums, or I can say the ball, if you compare the situation to a balloon, when there is an air inside the balloon and you just open the mouth of that balloon, it will just take not even take 1 second, 2 or 3 seconds to blow off that entire air outside. Similarly, when the event is over, the implied volatility component, the vega component in the options premium, vanishes very quickly and very sharply. It is like magic. So today luckily is a good event, so today you can verify, you can check this particular phenomena tonight, I mean the afternoon, because my time is IST. Dynamic leverage, I already covered this and mentioned that the this is what is the beauty of options trading, that when you are right in direction, it looks like that you are holding now more number of shares for same move in underlying, and when you are wrong in directions, it seems like your size of holding of underlying has decreased. So this is what is called the dynamic leverage. This was the Black-Scholes model, which no one has to remember, and I guess no one remembers. This is how the options premiums are calculated. This is generally automated, because by the time you will calculate this, the values of the particular thing will change. So we need not to go into all these mathematical things. It's just for the information, knowledge for all of us, so that we know that what we are doing and what is the mathematics behind it. Otherwise, this options pricing model, I guess no one has no interest in this and should not be as well. So let's come back to the Delta Exchange website, and let's speak more on these things over here. Till here in the theoretical part, any doubts, gang? Anyone would like to ask any of your queries regarding this? Cool.
Yeah, guys, if you have questions, please, this is a good time to ask. There is no rookie questions. All questions are appreciated. Don't be shy.
Concur, if there is any question, do let me know, okay, so that I don't change my screen.
All right.
So here we are on the options page of the Delta Exchange. So let me just route you to the page. So this is the landing page of Delta Exchange. You can see the daily 24 hours volume of the options on Delta, and 24 hours and 7 days volume. You can, if you want to trade futures, you can just simply go towards the futures. You have the the trades, the charts over here. You can use the indicators and likewise plan your trade. This is the order book, which we call as bid and ask panel as well. This is the trading panel. Let's come to the options part, which is of our key interest over here. So here you can see beside the table BTC Ethereum. So currently you can choose BTC or Ethereum over here. Okay. Below this you can see 22nd Feb, 23rd Feb, 24th Feb, 3rd of March. So these are the expiries basically. So this is 22nd Feb, 23rd Feb, and then 24th Feb. So this is D1, this is D2, and this is W1, this is W2, and this is likewise weekly, bi-weekly, monthly, and bi-monthlies. So we do have expiries open till 28th of April. So it's sufficient amount of options where you can play all kind of strategies and stuff over here. Below this you can see this side of data is call options data. So you have the entire informations of the call side. This side you can see the put option, so you have the entire information of the put side over here. Currently we are on the prices, so we are just getting the prices over here. If you want to see the Greeks of the options, you can definitely come and see over here how much which strike is having what delta, what gamma, vega, theta component. But as I mentioned that Greeks, you should be knowing that what is the Greek and how the Greeks play a role. Based on the Greek, trade is never decided or never planned. If you would like to come to data, the datas, you can come here where you can guess the OHLC values, the open, high, low, and close of any options strike. So let's come to the strike. Okay. Uh, as I mentioned, that at the money call options are having 0.5 delta. Let's just verify for you guys. I am picking 24th of February, 24 168. This is the underlying value by the 24 168 underlying. So 24 165 should be the the at the money strike. So let me go to 24. Okay, let me choose 23rd of Feb. Okay, this one. So let me open the delta value, the Greeks now. And for 24 165, you can see the delta is value 0.5 over here. So as we were discussing that when you buy the options, look to buy the at the money call option, where because the delta is 0.5. So doesn't mean that when you plan the trade, just go in the Greeks and see where it's 0.5. No, that's not the right way. That is just you should be aware that what the Greeks play blindly. Okay, buying the options at the money 24 200. So you can choose anyone 24 100 or 24 200. Likewise, you can do if you are feeling that you would like to give less premium, you can even buy 24 500. Now there is a one challenge: options buying and options selling. We will take that part today. What is the pros and cons of options buying? Okay, so in options buying, as I mentioned, that delta is the Greek which will reward for your right direction. So there is a big component in options buying, that is the time value. So your direction or the movement in the underlying should not be delayed. When I say not delayed, I mean to say the momentum should happen in such a time that the time decay that is happening in your options premium should not become sizable. Okay, so let's come back to one graph, one chart, and let's do one thing. Let's say I am just coming to a BTC chart, and let me come to a lower time frame. Let's say this, or let's say I'm coming to this. Okay, cool. So this is, let's say I have put this way. Okay, so I was expecting if when BTC will come down to these areas of 23 400, 23 500, I will be looking for the long or the buying opportunity over here. Okay, the logic for why to go long and why to go short may be subjective, and it's all up to our technical skills, so we'll not get into those. People who are flip zone players, they could have understood why I have drawn this line and why this trade had worked out. So let's not get into that part. So let's say I expected when the BTC will come down, I will be looking to buy BTC with a stop loss of this if this plays out good, or let's say this area. So let me draw a zone if I can, if it is allowed to draw. Yeah, it is cool. Let's say I have drawn this area that I will be buying the BTC in this area. So the early hack for me. So now the challenge for me: should I take this long opportunity in future? So should I take this long opportunity in options buying, or should I take this opportunity in options selling? So this is the judgment as a trader we need to understand. So let's say a person says, okay, I'll go in future. So definitely there was not a matter for him. He or she, they would have definitely taken the entry with stop loss this and would have taken the right for gains. Let's say another guy who had chosen to buy options over here. So definitely it was a bullish momentum. So call option would have been bought over here. So let's say it was 23,500. So definitely the guy would have bought 23,500 call options. And this event happened on 17th of February. So definitely he or she would have taken an expiry of at least a week or more than a week in his hand. Okay. But let's say if he or she would like to compromise on the premium that he is paying, so in that case, one can choose a smaller expiry. But the only hack or only thing that needs to be checked when you are giving less expiry, that the momentum should be sharp. And why, when I'm saying why should the momentum be sharp, the reason is this. Let me let me okay, I'll choose a paint actually. Okay, what I'll do, I'll just make some zones over here. Let's say this is a support and this is a sort of a resistance. Okay, so I'll put certain colors so we understand this is support. So let's say this is a support zone area, and let's say this is a resistance zone area. So we expected the price to come down to this area, and price came to these support areas over here. Okay, in our case, okay, let's say one of our trader expected the price, the momentum to be very sharp. So in that case, the price came to this area. In next 1 hour it was like, with some slowdowns and all, it finally touched this area. So a move of, let's say, $1,000 was expected, was done in next 2 hours. Okay, so in what happened in this, the movement of $2,000 was done in just 2 hours. So in this case, what happened, that theta, the time value component, was not very sizable, or not was very uh, affecting your delta. Delta is in Greek. So in that case, you were able to make bigger profits, or you were able to at least make profits. But let's say in a case scenario where the value, where your price came to this area this way, and then actually passed another 1 hour over here, then this way, then again came down, then again get up, then again came down, then again this, and in next 3 days it touched your area. Let's say it passed 3 days over here. So in this case, despite your targets have come in your options buying, you might not be in profit. The reason is simple, because in options buying there is a hidden component, which is time value. So even if your underlying was not doing anything, and even it was not putting giving you stop loss, but it was taking your time now, it was eroding your time. So that theta component erodes your time. So when you are buying options, you should be very careful that the momentum should be sharp. So as a trader, when you choose a trade where you are choosing a trade of options buying, you are, or should be in a favor where the price should give you a sharp action. It should not be a slow action. So let's say if this was not happening fast, let's say if it came down and then this and then came down, then this again, then up, then down, and the target was achieved, let's say in 5 or 6 days, then you would have been in the loss in option buying as well, despite there was despite you got your target. Are we good on this, guys? So this is a very crucial thing which we are discussing right now, options buying. Despite you making right target and option buying, you can still be in the loss. Are we good on this part, guys? This is very crucial. I need yes, no from each and everyone over here. Anyone else? Please, at least tell me yes, no. Clear, okay? For Casey, it is clear. For Gokan, clear, okay. Iraq, Iran, All clear.
Let's
Let's
sum it up. Theta is your friend when you're selling the option and your enemy when you're buying the options. So it's easy to remember like that.
Yeah.
Yeah, the
So
more the time, the more the price spends time in a tight area and away from your target, the strike price, you're gonna get hit by the theta decay by time, as Anand very well explained. So that's the thing.
so now let's come to the option selling. So let's say this 30 minutes chart. Okay, let's come to 1 hour chart. Okay, come. Okay, cool. Let's come to this area. I'm deleting all this for easiness to understand. So see, from price action, it is very clear over here. This price has made a triple top over here. Whenever the price is going up, there is a rejections, and that too is heavy rejections. One rejections, two rejections, three rejections, four rejections, five rejections, six rejections, seven, eight. So there have been couple of rejections over here. So, but yeah, not because if you see, these are the rejections on the top. But if you see, if anyone is a demand zone, supply zone trader or a support resistance, then will you agree to me that this is the nearest support area for the price, right? And we broken this area? Not yet. So definitely there are rejections from the top, but these rejections have not been able to or have not accomplished any achievement till now in life. Agree, there is a rejection, there are big red candles on the top, but they have not been able to achieve anything great in life till now. Okay, so definitely as a trader, I might think that okay, price will definitely feel a pressure on top, but may not be able to go down to 22,000 or 23,000 sort of areas. Okay, so that the case, I cannot take the shots in futures over here. Even I cannot take the put options over here because I don't know if the price will go down. If price starts dancing over here, I am done. The price will dance and I will be dead over here. So in that case, what I could have done, I could have gone to 25, 200 or 300 call options, and I could have sold them. Let's come to the charts again. Let's see. So let's say I'm choosing an expiry of 23rd. Okay, so, and as you can see over here, okay, let me pick this, and let me pick this 25 200 call options. Okay, not this because this was launched today itself because of the weekly D2 24th. So I'll go to 25,500. Okay, let me go to this. This will have sufficient data, yes. So okay, so guys, let's say if anyone, okay, this was one of the impulse which came down. Second time it came to this. Okay, I'm not saying okay you failed to catch this, but let's say if you, this move was able to capture at around 680. Let's say we are not taking an entry at 680 itself, we take an entry at 580, or let's say we are not even taking an entry at 580, we are taking the entry at $500. We sold this option at $500. That means we are expecting, see here we are selling the options. So we buy the options when we expect the underlying to go up. We buy the call option when we expect the underlying to go up. We buy the put option when we expect the underlying to go down. We are selling the call option. That means we are expecting the underlying not to cross 25,500. In this case, I'm not saying that the underlying will fall or go up or will go sideways. The only thing what I'm saying over here is the underlying will not cross 25,500. And for most of us to guess that price will not go this, see, if I ask you what can price do today evening, will it go down or will it go up, we all must be very confused. We'll say we are not sure, it can go down, it can go up. But if I then put up a condition, do you think the price will come down to 22 to 200? No, no, then we will say no, no, it will not happen today. It will take 1 week or maybe another month, but not today. It will take 2 or 3 days. Okay. Let's say I put up another condition. I say, let's say I'm saying, do you think the price will go to 27,000 today evening? Most of us will say, no, no, doesn't look like, it's very not possible. So when you're not clear, but yes, you are sure that, yeah, this will not happen or might not happen. So in that case, option selling makes a lot of sense, because because what happens, or when there is sideways consolidation in the market, that's the best thing to eat the premiums. Okay. So coming to this part, so let's say if you would have sold something around $500 also, those $500 have already become $79 right now. So there is already a profit of $420 over here. So let's come to an example this way. What happened when the price has come? You are sure that this is a fresh support area, and this is a fresh demand zone, or a, sorry, this is a resistance area and this is a support area. Price is likely to trade between this, and price is sandwiched between these two zones and will not cross them. Price will what price can do? Price will come to this area, will go up, will come down again, will go up again, will come down again, will go up again, will hit this area, will come again this, touch this area, will go this area, will again come to this area, will again come to this area, will go this, will go up, and then it will do a fake out, will again come back again to this area, again will do some time pass, and then again will come. So we'll wait for another event. Okay. So what has happened in this area? Option buyer will not make the money. Option seller will make the money. So in this case, let's say this portion, the top area, this guy. So let's say here someone has made, let's say this area was 25 200. Okay. Let's come to this area again. So let's say this area was 25 200, 25 500. So you could have gone another 500 points, or let's say another $1,000, and you could have sold the call options over here in these areas, this kind of areas. So definitely when there is, I'm not saying that the price will fall, but yes, if even if there is no movement, if there is just this kind of behavior, you still make the money. And the options has to become zero at the end. If the price is not able to cross 25 500 till 24th of Feb, this options premium $77 has to become zero. And this is universal truth. The sun can stop rising, but this $77 has to become zero. Anyhow. Any doubts on this, guys? Yeah, Casey. Okay. So Casey, this is all up to your technicals, I'll say. This cannot conclude in a there is no such rule when to buy the options, when to sell the options. I can just only tell you one thing: when you expect the move to be sharp, when you expect the move to be in your direction, and that too very sharply with less time, you should be looking to buy the options. Otherwise you can look to sell the options, but with uh, you know uh, protection in your hand. Conqueror knows my habit. I'll just come to this area because, so what I do in case of option selling, so I'll just draw a couple of things for you. So for me there is certain hindrances for the Ethereum. The first is this. I'll just mark this as, sorry guys, and I'll pick. And will you guys agree to me there is another resistance over here? There is another resistance over here. Okay. So when the price will come again to 1660, I will go and I will sell 1700 call option. So if price will go up again this, then there is another supply zone, then there is a third supply zone. So you can choose three layers of security or safety when you sell the options. On the downside as well, if there are a couple of demand zones, take out demand zones, price you not sure which demand zone or which support area will work out. In that case, you can just choose the lowest or the last demand or the last support area, and just can sell the strike just below that area. Guys, clear on this part? Similarly on the put side and on the call side. So uh
Guys, please note that, look, Anand, when you're selling options, not buying, when you're selling options, Anand, you just explained that he needs cushion between, some supply areas. If you're, selling calls in between your strike, and like a few layers of protection. And that is the reason. The reason for that is basically, since the buying of options has infinite potential for profit, you're on the other side of the contract by selling the option, so your loss can be infinite. Okay, if the underlying starts going against you, then the loss can be like catastrophic, basically. So you need to really take this seriously, and it's not just a game. You need to know what you're doing. By saying selling options, it's a total different thing. Buying options, you have a fixed risk. You pay it upfront, and you just sit down. That's it. Not like futures, you're gonna get wicked out or something. It's just you pay the premium first and have the position, have the exposure. But the other and the potential of gains is infinite technically. But when you're selling the option, you're on the opposite side of the contract, so your loss can be indefinite. Okay.
cool. Okay, so just few couple of things on this. So as Concur was mentioned, in option buying, the loss, maximum loss that can happen is the premium that you have paid. That is the maximum loss that can happen to you. No one can come back to your home and say, okay, you just paid me $1,000, I need 1,000 more dollars. Okay, no, never possible. In option selling, there's no level of loss. But with a caveat over here, option selling is the one where the chances of profits are maximum, or I'll say close to 95% or even sort of things. How I am telling you, let's come with an example. We all have the insurance providers in our countries, in our cities, everywhere. We buy the medical insurances, we buy the life insurances, life coverage. So I guess we guys generally pay $200, right? For an insurance of, let's say, $100,000, right? So we as a retail traders, we as a citizens, we as a normal people pay just $200 against expenditure, or against money which we are spending, or against, I'll say, the premium for I'm from India. In India, we call it as a premium. I don't know about your countries, if your country also you call it as a premium. That you are buying an insurance, medical insurance or life insurance for a premium of, let's say, $200. So you pay a premium for that insurance, $200, against life coverage of $100,000. Now you tell me one thing: who is the smarter guy in the room? You, who is paying $200 for a life insurance of $100,000, or that insurance company who just taking $200 from you? And if anything happens to anyone who is holding that policy, who is holding that insurance, the company is bound to pay him $100,000. Who is the smarter people? We will say that we guys are making, we guys will be in the profit at the end of the day. But guys, all these insurance companies are in the profit. No insurance company has made the loss till now. Okay, so they are the smarter people in the room. Similarly, coming back to the options buying and options selling with an example. So let's say I'm coming to 21st of Feb, 25th of 25,000 strike. If I buy these options, I'm going to buy these options. I'm buying one BTC. For buying one BTC, sorry, for buying one BTC of these options, I need $163. Okay, just try to correlate. You are buying an insurance of $25,000 by paying $163. Okay, so these are the retail traders over here. Let's come to the sell side of these options. Again, I'm going for the best with one BTC. For selling these options, you need a margin of 2419 and that to 10x. Let me reduce it to 1x. So selling this strike, you will need 24,200 US dollars USDT to sell this option. You tell me one thing, a guy who is spending $160 to buy this and another guy who is paying $24,200 to sell this, definitely the guy who is selling this is having higher money, that is why he is able to sell. But since he is having higher money, his potential to trade in the market is higher. Definitely he has come with certain more knowledge, more information in the market, or if the purchase power of this guy is more than the options buyer guy, definitely, hence it is supposed in the market, which might be wrong if you, if sometimes it's plays in the other way around, but it is supposed in the market that the option sellers are always having an upper hand in the market, because they are the guys who are the real market makers. They define the market and they move the market because they have big money with them, and they are the rich guys. Hope you guys get what I'm trying to convey. Why options? So everything has pros and cons. Option buying, you pay less premium. Option selling, you pay high premium. Option buying, you have less, the maximum loss that can be the premium that you have paid. In option selling, the maximum loss that can happen is infinite. In option buying, the profit is infinite profit. In option selling, the maximum profit is just the premium that you have sold. So the option, let's say if someone would have sold 25,000 call option, the maximum profit this guy would be making is $153. So just for making a profit of $153, he is paying a premium of 20. He's putting a margin of $24,200
But per contract.
per contract, right?
Yeah.
Per contract only. So you can understand the kind of ROI this guy is making.
Then the gain should be $1,500 almost.
Yeah.
Max profit.
So you can, so we have discussed the pros and cons of options buying, the options selling.
Alan, there is a question. Alan asked. Let's imagine we sold the call options at 25.2. Since we didn't think the price would rise about 25.2, what happens if the price quickly reaches that price and then begins to fall? Is our position closed, or maybe keep printing as the price declines?
Okay, cool. So if 25,200 comes very quickly, very sharply, as soon as you sold the option, definitely you will incur some certain losses in the accounts. But it's all up to you if you wanted to take those losses or not. If you are sure that okay, so and so kind of things will not happen. So let me tell you one scenario that has happened with me and Conqueror, and he knows me for quite a long time now. So something back happened, something very interesting over here, I guess. Yaro, it was something. Conqueror, it was 1800, right now.
Let me see.
It was a big drama that happened actually. It was 7 or 8 months back.
Yeah,
So your question is inclined to the same thing that happened with me, but we played it very smartly actually that day.
yeah. I think it was CPI or something, some event
Yeah,
for
it
them.
was an event that actually took certain issue with us.
I'm also trying to.
No, no, it was this guy. I got it. It was here,
Let me see.
1300 400 this area.
Yeah,
I got it. I got it. Okay. So with this
yeah.
example, you will understand what is your answer and what actually happened in these scenarios. Okay. Okay. My mouse is stopping. Okay. So guys, you can understand this behavior. It is the same situation that we are into. So there were heavy rejections actually this area. Okay. And when so what I did, okay, we had 1 2 3 4. So I just went and I sorted certain call options of this something like 1340 or something, yeah, 13 this areas. So what happened, due to an event there came certain big momentum towards it, and our options sold options started giving certain losses over here. So but we were pretty sure that this whatever happened, the 1360 should not be crossed, and that's what happened. The price started going up. So what we did to hedge our position for this a while, we took a future option, so the future over here. So what happened, if the price will cross 1360 and I have future long as well, so my future long and the option call sold option will move in the same fashion. So the loss that I will be making is only till this point. After this point, my futures and options loss, the profit in futures and the loss in option will be taken care by each other's. Okay. But the beauty part is was that in options we paid certain premium. Oh, sorry, we collected certain premiums, which was actually the time value and not the actual intrinsic value. So we knew that that particular time component has to become zero at the end. And second, we were also aware, we were also knowing that the price has to fall down again. It because our expiry was I guess 1 or 2 days in hand only. So we were knowing that yeah, it will not cross in 1 or 2 days. It will definitely give a pull back to the lower areas, and that's what happened. So coming to you back your question 25.2, definitely it will be a loss if the price comes very quickly to 25.2. But if it takes time and then come to 25.2, you will not be in the losses. And if it comes to 25.2 on the day of expiry, you will be in the profit. I repeat, if 25.2 comes on the day of expiry, the expiry which you have chosen, you will be in the profit. Is it clear? Why you will be in the profit? I guess this question was for Iran. You will be in the profit if 25.2 comes on the expiry day because of theta, right? Correct. The insurance company because they have millions of customers. Ah, okay, okay. An entire BTC value. Okay, yes, right. Entire BTC value, right? Are losses realized immediately or realized on the closing the options? The losses are realized only when you close the option. Okay. Any more doubts? Conco, anything you would like to cover, convey, or we can look to wrap in the session in the next 5 minutes?
Yeah, if there is no more questions from anyone, we can wrap it up and prepare for the next one.
Cool.
We can
So,
on the next one we can cover we can do some live examples. We can go over
yeah,
the strategy builder function.
yeah, yeah,
Uh,
definitely.
yeah, I
So,
think
so
those would.
guys, just a quick, one timer or trade setup which I can give right away or just can share with you guys. So this is very clear to all of us. We are totally on the point that 25 200 price should not cross that easily, because we have seen high resistance being built up, the good amount of delta being generated over here on the negative side, and So one can look to sell 25,200 call options or even 25,500 call options. But if, let's say, if you have any doubts and you feel that price can move up, you can straight away go and buy. Let me come to this area. 25,500 call option is at $84. So you can go and sell this. Okay, $84 is just a free money for you. But let's say if you have a doubt, okay, if price comes back 2,500, then it can definitely go to 28,000. So in that case, you can sell 26. You can buy 26,000 call option, which is $52. Okay, as the event will pass, this will come below $40, I guess. So still you will be making, if nothing happens, or if the price moves up, you will still make a profit of $30-40. And since your position are hedged, you will get a margin benefit as well if you have taken that benefit of margin trading. So this was clear to you guys. How can you be in a profit in this case? Oh, so if you receive 80 bucks selling call and spend 40 bucks buying call, so 40, yeah, you have received 80, you are spending 40 out of it. So 40, you are still taking your home, right? So 40 is something which you are definitely going to get. Good. So in options buying, so what are the prerequisite or what is the condition to make you money? The move should be sharp. Okay. The move should be in your direction. Okay. And third thing, the implied volatility component should not drop. Okay. Then only you will make a profit in options buying. Okay. Coming back to option selling, just a revision and just something like a takeaway from this session. In option selling, you don't need a sharp move, you don't need a right direction, you don't need, even the if the IVs doesn't cool off, there is no problem at all, because there is something that is gonna happen that you cannot control, or that is something which no one can stop from happening, and that is the time decay, the time passing by. Today is 22nd, tomorrow definitely is 23rd. Not even God can make tomorrow 22nd of Feb. So that is your good chances of making the money. Make theta your best friend, and there is no one that can stop you from making money. And that's what I said. 95% trader option sellers make the money, but try to play it very safe. Don't sell at the money call options. Whenever you sell the options, go out of the money, and you should have multiple confirmations in your hand. When I say multiple confirmations, it could be multiple supply zones, it could be multiple demand zones, it could be multiple indicators suggesting that way. And never play near the fire. Okay, just one quick example and then we'll wind up the session. It just option selling, you can just compare the situation so that you don't do a mistake, because option selling, 95% people may make the money, but those 5% people who don't make the money in option selling are the ones which lose everything in life. So why? Let me take one example for you quickly. 1 minute, we'll wrap this session again. There is a firecrackers, or you say when there is a cold in our house, we keep fireworks in our house. You must have generally observed the smaller people in the house, or the kids generally sits below the fire, very near to the fire, and they starts playing with the fire, either with some stick or something. Okay, the the matured people in the house, the parents of those kids, generally sits at some distance, not very far, just another 3-4 steps away. The old parents in the house, they sit very far from the fire, actually, very very far, and they are busy in their own style. Okay, so just understand who is actually enjoying the fire. Are the kids enjoying the fire, the parents enjoying the fire, or the grandparents sitting at the last? You know the answer. If anything wrong happens in the fire, it is the kids who will reach the hospital first. If any fireworks happen in that fire, there is no impact on grandparent, but grandparents are also not enjoying the warmth of that fire. who is actually taking the maximum enjoyment or the maximum safety of that fire, it is the parent. So what I'm trying to say, or what I'm trying to convey, choose the optimum distance, choose the optimum time to sell the options, sit at the right place, do not be much far from the fire, do not be much closer to the fire, and do not be much closer to the expiry, and do not be much far from the expiry. That's all, guys.
Yeah, great, great anecdote, man. And one last question. Gökhan asked a question before, just a simple question. He just asked, is trading options better than futures? Well, it has many benefits over futures. For example, if you're a trader that is having trouble with the placement of stops, you can understand the direction of the trade, but you don't know where to place the stop, then the options is for you. Imagine that futures is like 2-3 dimensional trading, options is like 5. So options has many variations where you can play it out. You can hedge your positions, you can hedge your hedge positions, you can play around with many things in options. Now we'll cover the basics, and in the next sessions we can cover the strategies once everything is set, and you're going to understand exactly why I call the options is a 5-dimensional trading tool, basically. So and also you make money when the price is moving. You make also money when the price is not moving. So in futures you cannot do that. When the price is stuck in a tight range, you cannot make money on futures. It's not easy. But on options you can do that. So yeah, now you decide if it's better or not. And plus the risk is defined. You cannot get wicked out. You pay the premium first and then just wait. That's it. You cannot lose more than that if you're buying the options. So again, let's wrap this up. Thanks for all of you for joining. Big thanks to Delta Exchange, our sponsors for this. They made this happen. Big thanks to Anand to share his knowledge with us, share his time with us, and see you in the next one.
Thank you, guys. Thank you, everyone. Bye bye. See you soon. Thank you, Ren.